Hi, welcome to the Economics Circle. In this video I'm going to take you through the issue of deflation. We'll examine the current concerns with deflation, provide a review of textbook style analysis, which is great for students, and then provide an overview of policies and their problems. So first of all, let's make sense of deflation. It's often in the news today, and we're keen to review what the actual issues are. Often political and media soundbites are immersed in fear-mongering language, or a theoretical framework that they're not explaining. Deflation is, for most commentators, something to be feared. It always comes with a D word, an alliteration of disastrous or dreaded or deadly or just the D word, right? Now, without doubt, deflation has its effects. Inflation, for example, enriches borrowers over lenders. So if you've borrowed money, you're paying money back at a devalued rate to the lenders. On the other hand, deflation enriches the lenders over the borrowers. Lenders tend to be few compared to borrowers, and this is why there's a lot of concern over it, because with deflation you're going to be affecting a lot more people than you are with inflation. And governments are more often than not borrowers. To see where the current balance lies, it's worth looking at who is in debt. These are recent figures from January 2015 from nationaldebtclocks.org, well worth having a look at. Great website to have a quick review and watch the debt climb for all of these countries minute by minute. It's rather entertainingly scary, really. Now, in the United States, we've got 104% of GDP, Japan 198%. These are all in the trillions, but this is a dollar rate, so dollar rate compared to local currency is something different. So in Japan, it's actually hitting the quadrillion. For us economists, the GDP percentage is more important. So reviewing it, we've got Russia at 11%, quite low. Greece at 215% and Japan at 198% are standing out as in rather problematic situations. The UK at 90% and the USA at 104%, as I said. These are all relatively high, in fact, very, very high for economies mainly in a peacetime situation. So is there much to be feared here? Well, national governments are heavily indebted. This means that the tax revenues that they are gaining from taxation from people and corporations are struggling to cope with government expenditures. Now, on top of this, central banks are engaged in complex strategies to inflate the money supply. They can call this quantitative easing, which is printing money electronically rather than just printing notes, or ZIRP, which is zero interest rate policies, should be an S on the end of there, without, and this is the key thing, without unleashing general price inflation or hyperinflation. Now this is what we can call a precarious policy. The leading central banks do not want to give any concerns to the markets, for a run on any of their currencies would create mayhem. Now on the 15th of January, just last week, 3 days after I'm writing this, 3 days before I'm writing this, the Swiss National Bank removed what was a cap on the euro. They were keeping the euro propped up in that respect. And by removing the cap, they did this unilaterally, surprised everybody, it caused a temporary havoc on trading systems. Now, why did they do this? Well, there's a clue therein to modern inflationist policies. The Swiss had maintained an informal peg with the euro, protecting it from falling in value against the Swiss franc, or CHF in the currency abbreviations, by purchasing it on the currency markets. So they kept on buying the euro on the currency markets to keep the euro higher than what it is really worth. But by propping it up, giving it an artificial lift, this was costing the Swiss banks more and more each month. Removing the prop, the euro fell 30% for a few moments, then hovered around 20% fall. So that suggests that the euro had been devalued 20% through inflationism over the past year or two, whatever it was that the Swiss banks had kept the peg going, right? Central banks generally engage in inflationism. Inflationism is a policy to print or expand the money supply. Print money or expand the money supply. Really, since the inception of central banks, inflationism has generally been the policy. Now, recently, under the influence of monetarist economics, central banks have followed a rule to expand the money supply by 2% to grow with and supposedly to assist the economic growth. However, we can evaluate this point and say, well, there is no logic why the money supply should grow at the same rate as the economy, except to avoid causing a deflation in which the value of the currency rises. So, because if the money supply, broad money or narrow money, is kept stable and the economy is growing, prices will fall. and this would be cause a deflation in the general price index. So the central banks tend to like to print money anyway. Again, there is no economic logical reason as to why an increased money supply increases productivity. Just because there's more money floating around and circulating, that doesn't create more farms to produce more wheat or more factories to produce more cars. Except we can add through the distortions created by alterations in the interest rate and the price of capital. The key word there for us economists is distortions. To what extent is central bank distortionary? Now let's have a look at my country, the United Kingdom. It's practically the same for all Western countries. There's very close similarities here. The UK Composite Price Index from 1750 to 2000. If we look at that, we have, there's volatile times around wars, funny enough. There's Napoleonic Wars, French Wars here, Napoleonic Wars. Settling down in the 19th century, there's one or two banking crises here when the banks were printing more money than what they had reserves in their coffers, funnily enough. We have blips around about the First World War, and then after the Second World War, again a blip here. After the Second World War, we have a constant growth in inflation. Now, this is a logarithmic scale. Logarithms tend to reduce the exponential growth that we should be seeing. We wouldn't be able to fit it on the graph, for example, as to how much prices have gone up since 1750. So logarithms are powers, like 10 to the 1, 10 to the 2, or 10 to the 2.674, to show growth, sort of flatten growth rates. Very powerful tool in maths. But for us who are evaluating this, we've got to be aware that this graph is actually squished, as it were. Now, against this backdrop, we have the fears of inflation, deflation. So if you have a look at that move of inflation going up to 2002, 2003, etc., and it continues on to 2011 at a constant growth rate. Against this backdrop, we find there are fears of deflation. Prices in Europe are said to be falling a little bit. And Japan, according to the media, has been dealing with deflation for over a decade. But if the central banks are pursuing an inflationist policy, how can prices fall? And are prices falling that much? Well, if we look at, again, I'll use the UK, but the United States, Canada, similar sort of graphs. If we look at recent data, this is the kind of data that central banks produce, or this is from the Office of National Statistics. We look at, let's just take the CPI, the blue one. It looks kind of calm, like there's not much going on there. You've got a high here of 5% inflation 2011. RPI fluctuates a little bit more because that includes house prices. House prices were dropping, and you have a deflation here of just over minus 1.5%. 2009, before shooting up again to 5%-ish over 2010 to 2012. Take an average of those, you're probably fluctuating around about 2%. Now, surely this is a good thing. Right, looking at that, rather calm, but when we look at it, this is from marketoracle.co.uk, financial markets and analysts. Look at this as an exponential inflation trend from 1997. Just before the Labour government got in 2000, there has been a constant inflation year after year after year after year. Slight dip there, yes, that was the crisis time, 2007, 2009. Still growing, still growing. So we have to ask ourselves, to what extent is there a deflation going on? If there's a slight dip here off the trend and then it just continues ad infinitum. We're in an inflationary economy, have been since the Second World War and even going back to the First World War, and a little dip in prices is not going to be that much of a counter a trend at all. Right, let's have a look at a theoretical view for economists. If you're doing Econ 101 classes or doing economics as an undergraduate or doing some A-level courses, what we're going to do is have a quick review of Keynesian theory, neoclassical and Austrian analysis. Now, this should be familiar to students. Don't worry if it's not. We'll go back to some of the evaluation in a moment. So with price deflation, what's happening in a Keynesian analysis is that there's a drop in aggregate demand. If consumption drops, investment drops, government spending drops, net exports drop, we will see prices falling from 100 down to 90 because the AD schedule is shifting to the left. And this is what we expect you to draw for exams or in short essays, etc., with real output dropping from Y1 to Y2. So this is a general Keynesian perspective, and the Keynesians get concerned, and we'll come back to this, that once AD drops, it might get stuck at this lower price level. People don't want to go spending, they don't want to increase their consumption, firms don't want to take on investment, and thereby the economy will get stuck at Y2, which is way below full employment, or Y1, where it was before. So in the classical version, on the other hand, we may see a collapse in aggregate demand because CIG, or X minus M, has started to fall, so AD shifts to the left. But compared to the Keynesian version, in which prices get stuck and the economy gets stuck in a rut sort of thing, the classical economists then emphasize, no, this will also cause wages to fall, which in turn will shift aggregate supply to the right, and we'll end up at a different equilibrium. So you can see here that the prices may drop further, but a new equilibrium will be formed at the old one, Y1. So we start off at Y1 with an index of 100. Prices fall because AD's dropped to 90. Then, because prices are falling, firms are going bankrupt or changing and reducing prices. Wages, let's say, will fall, and this will encourage supply to increase or shift to the right, bringing us back to the old equilibrium of Y1. So we end up with the same unemployment as at Y1, as from the initial situation, but with a lower price level. So in other words, the classical people see that the economy will get back to a new equilibrium just at a lower price. Now, another way of looking at deflation is that there may be an aggregate supply increase, just like with the classical move there. But let's say this comes from a natural fall in wages, or real wages, a fall in the price of raw materials, or the interest on finance and other things. This reduces the cost of doing business. So the supply side, or supply for the economy, will shift to the right, reducing prices, and the economy will move from Y1 to YF in this case, right? And another reason for deflation is that we may have a shift in the long-run aggregate supply. So long-run aggregate supply may shift to the right if, for example, there are technological developments that increase our overall productivity, the economy moves more towards free trade and liberalizes its markets. Right. That is a general review for sort of AS and going into A2 Economics or Econ 101. Now, other aspects we have to be aware of include that if we look at money, for example, money has a value which is dependent upon the supply of money to the markets. This is MS, or money supply. Now, the money supply is currently very elastic relative to a fixed money supply or gold standard system, in which the amount of money in the economy was generally fixed by the physical quantity of gold and or silver. Money supply today is elastic. In other words, when you use your credit card, for example, you're actually increasing the money supply. When you pay it off with hard cash, the money supply dwindles a little bit, so it bubbles all the time. Banks can create money out of thin air through fractional reserve banking, and that creates a great deal of elasticity that the central bankers cannot control. It's out of their hands, right? But they certainly create the system which creates that elasticity, so that's another argument, of course. There is also, the value of money is dependent on the demand for money. This is MD. Now, money demand is dependent on our willingness to hold cash versus our desire to spend it. Now, typically what happens in deflationary terms is that people increase their cash balances because they expect prices to fall further. So we hold on to more cash, waiting to spend next month or a few months down the road. So cash balances tend to increase, the demand for money increases. But the value of money is also dependent on not just money supply and money demand, but also the output of the economy, right? So if the economy is growing or declining, that's also going to have an effect on how much your money can buy, how much that pound or dollar or euro or rupee in your pocket can buy. So if the money supply is falling, including credit, then all things being equal, hold everything else constant, because that's what we need to do as economists to understand what the logic is. If the money supply is falling, the value of money will rise, and prices are concomitantly falling. On the other hand, if the demand for money increases, all things being equal, prices will fall, and again the value of money will rise. If production increases, all things being equal, I hold the money equation stable, prices will fall and the value of money will rise. Or if the demand for production decreases, AD in the typical diagrams, prices will fall and the value of money will rise. So all of these and a combination of the above can take place simultaneously, and that makes it difficult, except with historical information, to find out exactly what's causing the deflation at the moment. Now, currently what we're experiencing is an increased money supply, stagnating production, massive government indebtedness, as we've looked at, and also, because of the above, uncertainty concerning the euro, the ruble, spell that wrong perhaps, China's economy, Japan's decline, is America going to bring us out, is Germany going to be the powerhouse, etc. What's going on? Uncertainty in itself can cause people to spend less. Now, this is also a worry for the Keynesians. Stagnation in the supply side concerns the supply side economists and the classical economists generally. And the inflationism of the central banks is a great concern to the Austrian school of economics. Right? Now, what about policy evaluations? Should we increase government spending to get us out of this recession and get away from the deflationary fears? Well, there's not much room for most governments. If Japan's over 200% in debt already, if you sold everything, if you had 200% of your wealth, if you owed 200% of your wealth, so if you sold everything, you'd still owe exactly the same again. That's quite problematic. In other words, if you're in a negative asset position, you're not in a position to borrow or borrow easily. Now, high debt levels would imply that further government borrowing would seriously affect credit ratings, as it has done in the crisis in Greece, etc., in 2007 to 9. This would also imply taxes would have to go up and possibly raise interest rates, and this is something governments want to avoid. Well, what about increase the money supply? Now, inflationism, we've looked at, certainly improves the lot of the indebted, so governments can pay off their loans, corporations and individuals can pay off their loans with cheaper money. But on the other hand, economies need investment flows. That can only come from real savings, not artificial boosts to the loan markets, which cause distortions. Right. What about austerity? Well, the key question here is whose austerity? Often it's assumed everybody has to go through austerity, but when governments are in so much debt, the focus has to be on the governments. Now, reducing government spending will hurt government employees. They'll get upset because they have to lose their job or lose the amount of money the ministry is providing. On the other hand, most government positions are administrative or redistributive rather than productive. In other words, they don't create wealth, they just shuffle wealth around. They're taking money from the private sector to put into the public sector. Now, the public sector is needed to some extent. To what extent is arguable. We can all discuss that in another issue. But nonetheless, most government positions are non-productive. They don't create wealth, which means if you distribute resources, factors of production, I should say, back to the private sector, this can help the supply side recover. So rather than have somebody sitting at a desk shuffling Excel sheets and paper around and getting in the way of entrepreneurs and production, put them into the private sector, selling coffee, setting up businesses, etc. They're actually creating wealth. However, shifting resources from government-sponsored agencies or ministries over to the private sector can be highly contentious, and this can cause political and social upheavals. This is why often, especially we saw this in Athens, people start rioting, protesting, etc. Now, most of the people doing this are the government employees or dependents who are going to lose income, and that's going to be painful. And to what extent should governments do this quickly, or should they do it gradually? Is there a way of doing it without causing a riot and a rebellion and a coup d'etat? Right? What about raise interest rates? Now, deflationism as a policy to reduce the quantity of money in circulation will raise interest rates. Now, demand will fall as cash balances rise and firms may hold back on their own purchases today. This would create inefficient firms to become bankrupt. They will go bankrupt. And this would add to unemployment, though. However, higher interest rates will attract funds into the banking system, and this will improve their soundness. This is one of the big things in 2007-9, that a lot of the banks were rather dodgy. They didn't have the reserves for when people wanted to take their money out, and there were bank runs, like in the United Kingdom with Northern Rock, and we saw later things with the Cypriotic government actually raiding the banks to protect its finances, which is quite crazy. So by raising interest rates, the banks will attract funds in, and this will improve their soundness, which generally is a good thing in a capitalist economy. Now, if consumers are also pulling back from consumption, they will be saving more because of the higher interest rates. Prices will fall further. Now, this is where the Keynesians get worried, and oh my God, this is going to be a deflation. We're going to fall into stagnation. We won't be able to get out of this. We'll hit a liquidity trap, etc. But arguably, whenever prices go down, they always come up. Yeah, well done. This is when the investors go in. This is when the entrepreneurs go in and start to pick up the bargains, right? They get excited at this point and go, ooh, there's a car boot sale on houses or factories or businesses or shares, and they start to go in. They may hold back if they think prices are going to fall further, but ultimately they know when prices are falling, it's the time to get in the market. 2007-8, prices were dropping. By 2008, the quick investors were already back in the market, which stops the deflationary flow. Anyway, the deflationary falls. Now, policy evaluations. How quick any changes that are affected, whether it's an inflationism or a policy of deflationism, just to sort the economy out, how quick they run through the economy depend on many factors. Government intervention generally causes further uncertainty. We can compare the Great Depression of the 1930s, the Greater Recession as they call in this current one, with the 1919 recession in which banks raised interest rates, sharp shock to the economy, but in 6 months the American economy was back on its feet, and that was after demobilization, which is a huge supply side shift, isn't it? So 1919 recession is worth looking at. Now, what happened there? Completely opposite to what banks and governments have done in the last few years, and quite instructive. If you increase the money supply, well, you're certainly going to prop up inefficient banks and relieve them of the need to create solid reserves, so you're just prolonging the problem possibly. Rising unemployment, on the other hand, in a deflationary time can cause severe social as well as economic disruption, and this can be very painful for governments. And governments tend to want to avoid violent overthrows or rebellions and riots because they are costly. They make the country rather unappealing to come to, etc. Right? But on the other hand, if governments are seen today as being seen to be doing nothing, or even seen to be imposing misery on government-dependent groups, the political situation can become highly dangerous. So again, this may lead to coups d'etats. But if governments don't change their structural issues, if they don't get to the core facts that they are heavily indebted, they are carrying debt burdens which are unprecedented in peacetime, then they can, through their interventions by increasing the money supply, prolong deflationary periods, or what we generally call recessions. Right, guys, I've given you some things to think about there and give you some reviews of analysis and some evaluative comments. It's up to you to think what you would do and defend your position. If you found this useful, please like the page. This really helps us increase our subscription channels, etc. to people, because our goal at the Economics Circle is to improve economic literacy around the world, not just to focus on textbooks, but also to look at the logic behind them, show where there are theoretical disputations. Our governments and our countries are struggling economically, and there's no reason for that. So we're quite keen to get to as many people as possible and to give economics a really good name. Often people slight the subject because they think economics is not a science, it's not accurate, and all this nonsense. Well, actually, economics is incredibly logical, incredibly powerful. It has created enormous amount of wealth over the last 200 years plus since Adam Smith wrote The Wealth of Nations. Absolutely brilliant stuff. Yes, the environmentalists may jump up and down and say, what about the pollution? And you'll find economists have a lot of interesting things to say there. It can't be dismissed. And we often find that pollution is actually a government failure, not a market failure. Anyway, that's controversial. We've got a great subject to share with people, so we'd like to attract more and more people over to the Economic Circle. We also have a great magazine. We're now into our third issue as I write this. The Economic Circle magazine is out on smartphones, Androids, Google Play, etc., Apple Newsstand. Just hunt it down and subscribe. It's a very, very reasonable annual rate, and you get lots of articles written by some great writers. We have David Stockman, a very famous political economist over in Washington who used to work for President Reagan, writing in this month's, and we're going to have some good economists. We'll be interviewing people and providing a themed article for each, a themed issue for each magazine we produce. So this month's on deflation, the one before was on the BRICS countries, the one before that was on sovereign debt. Commodities are in the fourth issue. That's what we'll be working on for next month. Now, if you're studying AS and A2 economics in Britain, let me ask you a few questions. Are your notes in poor order? Do you find it difficult to keep up with the material required? Do you wish that you could review some topics such as elasticity or monetary policy in the comfort of your own home without those poor notes, and not have to trawl through YouTube videos pitched for graduate students or which are not very professionally oriented? Right, we've created an online course for you, specifically for AS and A2 students around the world. We're going to be expanding, and it covers Econ 101 as well if you're doing that. Our videos and graphic representations allow you to go over the key concepts, led by myself, Dr. Alex Moseley. I'm an author, economist, philosopher of background. I've produced lots of articles, etc., and I've taught economics for over 20-odd years. And in these topics, what we'll be doing is not just relating to the exams and the course you're on, which is absolutely critical, but also connecting economics to real life and to your wealth prospects. I always think if we're going to learn something, we better see how we can monetize from it and see how it relates to your life and your career prospects, etc. If you want to learn more, go to the economics-circle.com/live for more information. Now, the price for a normal one-to-one tuition with me would be more than £4,000 over 2 years. That's 2 years of tuition a week, and it's probably going up more than that. And if you're in London or some of the big cities, it would certainly be higher than that. And even if you get an economist doing one-to-one for a lot cheaper, you're still looking at £1,000 over 2 years for AS and A2 or micro and macro courses. The price we're offering is nothing like that. We're going to be offering you a very reasonable price to help get you on board and to help spread economic literacy around the world, to give you students access to all the tutorials you need in the comfort of your own home. We're offering a great deal where you can learn what you want from an expert. You'll be able to review when you want to. You can be at the bus stop, on the bus, or in the sixth form common room. You can replay the videos as often as you like. Take notes, something we recommend. So check out the current deal that's running. We always have a different deal because we tend to offer good deals earlier in the year, in the academic year, compared to just before the exam periods. Because we want to encourage, using a price signal, to encourage students to begin learning early rather than leaving it to the last few weeks and say, oh my God, you've got 120 videos for my 4 courses. That's way too much for me to learn in the last week. Absolutely, I want to give those people a price signal to say, hey, we're going to be expensive just before the exams because we want to encourage you to come on board earlier. You've then got the time to provide us with feedback and say, hey, Economic Circle, Dr. Moseley, please, you haven't covered this area or this article. I need a little bit more information. Can you do another video? Not a problem. We're here to learn and adapt ourselves. We're a business in the marketplace. We want to hear from customers as well. So the earlier you come on board, the more value you're going to get out of it. And our prices will blow you away. For the quality and the quantity, you'll be getting an awesome deal. So come over to the economics-circle.com/live. That will take you straight through, or economicscircle.com will get you straight through to the main page. Okay, guys, thanks for listening, and I hope to join up with you as students and to help you get the grades you want and to move up and onwards in the world with great economics behind you. Thanks for listening. Cheers.